Hi, everyone. Welcome to the webinar today. Today, we are going to do the financial remedy for the coronavirus panic. My name is Brandy. I am a U.S. retirement educator volunteer. U.S. Retirement Education is a 501c3 nonprofit, and we have a great guest with us here today. His name is Patrick Munro, and Patrick is the founder of North Star Financial Advisors. He specializes in safe money investments, which right now, with this coronavirus market volatility, is really a great thing to specialize in. And Patrick conducts thousands of seminars a year. He actually does about one a week, maybe two a week. I think we talked about Tuesdays and Thursdays, but through doing that, he provides education to his community, which is something that's very important to us as well. And Patrick is also the author of two books. The first one is called The Quest, One Man's Journey to See Every Country on Earth. And Patrick has tons of great stories about his travels. His other book is it's called Financial Fakery. And both of those books are available on Amazon if you just type in his name. And both have 5-star reviews. He is also a radio host. He has a 15-year-long radio show that is called Retire Right. And that is on WRNN 99.5, and it airs every Saturday at 9:30 a.m. So Patrick, say hello to our guests today.
Well, hello everybody, and Brandy, thanks for that. COVID, of course, has changed the game plan for everyone out there, and we're doing a lot of seminars now online. Of course, you're able to do more and more of those, but I've been doing this for 21 years. And we want to take you through some materials today that hopefully will be helpful to everyone who's watching this. So let's just begin with our next slide from here. And we have the states reporting. It's just a heat map really from the CDC, which was last updated on March 30th to show where the virus is. It's everywhere. And of course, when you look at the global heat map, it's all over the world. So it's changed a lot.
Oh, I'm sorry, I skipped one for you.
Go to the next slide.
Oh,
can't see that next slide.
I think the share went away. Okay, let's try that one more time. Can you see it?
I can. We're looking at a word called volatility. Many people watching this today see that word in the financial press, but the Dow, of course, plunging, over 2,000 points when oil is collapsing and price wars are going on. Who saw that coming? It's really got a word. It's called the black swan event. And if you are in variable investments like a 401k mutual funds, stock holdings, etc., you obviously see your accounts go down in value. And our goal today is to show you ways to save that from happening, because the closer you are to retirement, or if you're in retirement and something like this happens to you, it's not good. We look at this chart here, and this is the largest closing point changes as represented by the green and the red. And you can just take a look at those numbers and see the percentage changes. And these are, obviously some recent dates, some big numbers there on both sides. And it's basically talking about volatility and seeing how the markets are moving in this regard. U.S. banks and credit unions, of course, are running low on cash as customers are making big withdrawals, and some branches, of course, are closing and waiving ATM fees. But there's not a bank in the country or credit union that doesn't have withdrawal limits right now. And the FDIC reserve requirements on these institutions is anywhere between 3 to 10%, depending on the amount of deposits that they would have. Now, there's annuity companies that are out there that are required by law to reserve 100% of the amount invested into their annuities. So when you look at dangerous times, it may pay for you to look at what annuity companies can do for you. we go back into history. I'm a student of history, and the Great Depression that happened in 1929 and into the 30s. They used to call it the Dirty 30s. And at the height of it, about a quarter of the U.S. workforce was unemployed. Those with jobs saw their wages cut or their hours reduced to part-time. Well, that's been happening in America anyway. And of course, upper middle class people saw their incomes drop by as much as 40%. The average American family lived by this motto: use it up, wear it out, or make do without what you're wanting there. So women, of course, entered the workforce in increasing numbers. This is where they first made their entrance into the workforce, and families were able to maintain a middle class income by adding additional wage earners. Families got creative. They kept kitchen gardens and passed old clothes and hand-me-downs. That's where that came from. As they struggled to retain ownership of a house or a car, they became very, very creative in that regard. I'm a big sports fan, and when we talk about Babe Ruth, he was known as the Sultan of SWAT in his glory days, and this is in the Roaring 20s. His manager knew he was sort of an irresponsible guy, and he worried that Babe was blowing through all of his money without putting any of it away. So he introduced Babe to an insurance agent from the Equitable Insurance Company. It's now known as AXA Equitable. And from 1923 to 29, the slugger contributed more than half of his salary annually, purchasing between $35,000 to $50,000 worth of annuities each year. Well, then the Depression hit in October of 1929. Babe Ruth was forced to retire from baseball in 35 due to health concerns, and he was unemployed during the worst time in history. But Babe Ruth has income annuity. It's been reported that he received income of $17,500 a year, which in today's terms would be more than $290,000. So Babe Ruth and annuities, they liked each other. He invested 100% of his investment portfolio into annuities, and his famous quote still resonates today. He says, "I may take risks in life, but I'll never take a risk with my money. I use annuities and I never have to worry about my money." And that's from Babe Ruth. Pretty famous sports guy out there. Well, we're looking at 1929, and what happened as a collateral damage was tax rates shot up from 25% to 63% after that 1929 stock market crash. You can see it right there on your screen. The Federal Reserve's response was on March 15th, the Fed, this March 15th, of course, the Fed lowered interest rates from 1.75 to below zero, basically negative 0.25. The U.S. Central Bank has not made a cut like this since 2008. And the reason for it was, by the way, the chair of the Federal Reserve is Jerome Powell, and he said at a press conference, "We saw a risk to the outlook of the economy, and we chose to act by doing this rate cut." The Fed can cut rates very easily, but they have a tough time taking that back later by raising rates. And the last time we saw rates at this low level, they stayed there for 7 years, and that's from a financial analyst at bankrate.com. People say the stock market is a variable place, and when we all like making money in the stock market, but we talk about the impact of losses. This chart demonstrates that on top there, you'll see if you lose 10% on a $100,000 investment, you're left with $90,000. And let's say you gain 11.1%, that way you get back to even. If you look down the list, let's go down to 30%. You lost 30%, that means you have $70,000 left. Do you realize it would take a 42.9 rate of return just to get back to even? You look down to the 40 percentile. This is in the 2008 financial crisis. This is where most people lost money. Well, that brings you down to $60,000. See, we've done that for you in the chart. You know that takes a 66.7% return to get back even at the 100,000. You can see that on the far right. So the impact of losses, and the older you get, the more it hurts. You know, I like to say at my seminars, the ride down is a lot quicker than the ride back up.
So I always like to kind of remember back a couple slides here on this one about Babe Ruth and the Great Depression. Babe Ruth didn't experience any loss during the worst time in history. You know, we may have eclipsed that now with the coronavirus market volatility, but imagine if you had, been planning to retire in the next 6 to 12 months, you don't have the time horizon to make up a 30% loss. And then even if you do, how long does it take you to get back to where you started versus you could just avoid all of that?
Exactly, Brandy. Pretty powerful slide there. Well, there's things you can do to protect yourself. Well, you can have a private IRA. You can follow the rule of 100. We'll talk about that in a minute. There's bond replacement strategies, Roth ladder conversions, looking at your monthly expenses. That's important too. And then the implementation of a Rule 7702. So we'll look at these things as well. Here it is, the Rule of 100. We're all living longer. So maybe the Rule of 120 is now being recommended by many advisors to enable their clients to generate needed wealth growth to satisfy expense needs for the short and long term during retirement. And basically the way it works is you take your age, let's say you're 60 years old in this slide, do the math, there's 40% left over. So no more than 40% of a 60-year-old individual's money or portfolio should be exposed to clear and present risk in the market. That's the rule of 100. And when you turn 61, of course, that 40 drops to 39 to make the math work. Private IRAs, this is how the rich protect their wealth, including Babe Ruth, who was rich back in those days. Provide coverage for the most common concerns in retirement, reducing your advisory fees by the percentage that you place in the IRA, and also use it as a bond replacement strategy. You're getting market-like gains without market-like risk, and you're getting tax-deferred growth. The options are designed for growth, that is accumulation, and some are designed to help you generate income that can be used as your own personal pension. All of the underlying assets are guaranteed by the insurance company, and that's up to the claims paying ability of the annuity carrier that you work with. It's important to work with a highly rated carrier, and I work with only A-rated companies, of course. Now here we have the power of indexing, and you'll take a look at some lines here. The red, of course, is the variable market, as represented by the S&P 500. And of course, the guaranteed minimum contract in the annuity is there. That's the blue line. And then the performance of the green, annual monthly average. And this is for a typical portfolio of an annuity. You can see the outperformance there really almost out of the gate. And it does not participate in downs. You see there, we have a big down from 136 to 78,000. The green line doesn't participate in that. It just keeps going up. We have another, when you reach in the red, 145,000, it drops to 100,000. Nope, not the green line, keeps moving on. It's really quite remarkable over a period of time. From 1998 to 2016 is what we did on this slide.
And if you look at these slides, it kind of demonstrates a 98 to 2016. So if you got in 98, you got out in 2016, even if you were in the market, you still come out a little bit ahead. But what about all of those people that got out in 2011? They had all of those years in that very long time horizon, and they still made absolutely no money. They, in fact, lost money. And then throughout those years, we also have taxes and inflation to account. So they lost even more than what's listed there versus our safe index strategies that protect you from that kind of volatility.
Exactly. the term buy and hold. It's been used a lot, and it may not be the best strategy. And we put together a bit of a chart here. Brandy, let's let you take this one and just
Sure.
what zeros mean.
So a lot of times, the first place we invest is our 401k, just because that's kind of what has been coined as part of our American dream and saving for retirement. And it's easy to do. You don't have to think about it. You sign up and the money just comes right out of your check. Our 401ks generally are passively managed. So whoever's managing that, they encourage you to do a buy and hold strategy. Just buy it for the long time horizon. And no one's really paying much attention. It's just riding the waves 100% of the market. It's taking all the market gains and all the market losses. So if you, for example, if you had a 13-year period of your 30 years in retirement, that makes up about 43% of your retirement. If you're looking at this volatile chart here, for 43% of your retirement, you got nowhere. You're taking steps forward, but you're taking the same amount of steps backwards, or even more steps backwards. So looking at this, if you were to ask my opinion, I would say a buy and hold strategy is probably not the best, at least not for the majority of my retirement investments.
Right, exactly. Here's an example of an annuity from the Equitable company. It's called the Teton Bonus 14. Your hard-earned money, though, will not be invested in the market. By the way, in South Carolina, we use the Teton Bonus 10 because that's the government requirements here. So it's a 10-year relationship that you have using an index called the Barclays Atlas 5 Index, and it provides global investment coverage for the investor on this annuity. It's really quite impressive. You can earn anywhere between, in a bad year, 0, and we have a little nursery rhyme that we use around here at North Star. And you know, in the times that we've come across here recently, people losing all this money due to COVID-19, 0 is our hero. Mm-hmm. And in good times, though, you're positioned to make as much as 20% a year. So none of the bad and a generous upside on the good. What a great retirement. Options are for guaranteed income here. There's no downside risk, and the guarantees are based on the claims paying ability of the Equitable Casualty and Life Company. You know, it's been around for 135 years. So you can grow and lock your gains annually with the power of the indexing that you just saw in the last slide. Growth with safety is important. Market upside with an index that's averaged 7 to 8% since the inception with 0 market risk. The Barclays Index 5 smooths out the growth curve by rebalancing daily. So you're off golfing or doing whatever you're doing, and the good folks at Equitable with their Barclays partners are making sure that you squeeze the most out of what's happening in the world with that daily rebalancing. By the way, Equitable solvency ratio, that's an important word, is 114%. That means that they have 114% of assets on hand of the money that policyholders have invested and grown with their company. Very impressive.
And if we go back to the ATM slide where we talked about the amount that banks are required to hold on reserves, it is fractions of what insurance companies are required to hold on reserves. And then Equitable is even surpassing that with the extra 14%. So if you're thinking about where your money might be more safe, those are really important numbers to think about.
Mm-hmm. And always remember, for all of this, when you're working with the annuity, the cost is 0 versus a brokerage firm. There's a broker on every corner in America charges about a 1% fee to risk your money. So it's a way better deal here. Speaking of banks, you know, if you invest any money in a CD, in this particular case, the Ohio State Life Insurance Company, it gives rates of 4%. This is on a 5-year multi-year guaranteed annuity. We call it a MIGA for short. So this is just an example of superior rates of return Get 4% compounded tax-deferred growth on the money you have in bank CDs and money market accounts. If you invested $50,000 in this Ohio State MIGA, you'd make $8,346 over the next 5 years, guaranteed on the claims paying ability of Ohio State Life. And it's a $10 billion financial backed company. 4% is much higher than any bank CD rates that are offered, the average being about 1.65 to 1.7. These are taken from bankrate.com. You deserve to get almost 3 times the interest on your money, but you've got to have the right advisor that's going to help you make that happen.
Yeah, right now with the market volatility, if you are invested in the market, you have probably felt some pain from that in the last few weeks. So these strategies like a 4% interest or the equitable option on the previous slide that offers a 5 to 10% immediate bonus, these are the kinds of things that are going to kind of help you dig out of that hole more quickly and put your money to work for you much more efficiently.
This is a slide that we have here from Barclays. It's called the Index 5 Performance, and we've taken some dates here recently, 221, 228, 306, and 313. These are weeks where the S&P 500 was really challenged. As you move across, you'll see the Atlas 5 index, and the participation rate is shown there as well. You'll see some positive numbers in some horrific times in the market. That's called financial peace of mind when you see that in black and white. We actually take it in real numbers, moving from left to right. It gets pretty good that way.
Yeah. So the Atlas index, if you think to that chart we saw with the green line, our green column here is what that green line is doing. So we're still going up if you're invested in this product attached to the index versus if you're directly invested in the market where you would have, you know, on March 13th lost 16.09%.
Right.
And I will walk through this ladder conversion as well. So what a Roth ladder conversion is, if you can pull out of your memory bank that last slide we looked at earlier in the webinar about the tax rate hike in right before or during the Great Depression. It went from 20-ish% up to 60-ish%. So we knew that taxes were going to go up in the future. Now that we have a stimulus bill that's passed, we have huge government spending increasing. I would ask you to think about, do you think the tax rates are going to go up? Most likely they are. So what a Roth ladder conversion can do is you can take your qualified funds, those funds you haven't paid taxes on yet, and you can convert them, pay the taxes now, so that in the future when tax rates go up, you don't have to pay those fees. And you can do that with these safe money investments as well. So this is sort of a flow chart for that. And the way it would work is while you are working, you would invest in a pre-tax retirement account or a qualified account like a 401k. Then you would retire early. You would retire early because you were a avid saver and a very disciplined saver at the same time. Then you would transfer your employer's retirement account over to your IRA. I would probably encourage a principal protected IRA like we've talked about in this webinar, so that you don't have the loss of your time horizon and having to make up for those losses in the future. Then you would convert from your traditional IRA to a Roth IRA. So whenever you take a 401k and you convert it, it's then called an IRA, an individual retirement account, because it's not sponsored by your employer anymore. You wait for 5 years before touching the converted money. So that's kind of the medicine that goes along with a Roth ladder conversion. And then you withdraw those conversions tax and penalty free and enjoy all the extra money. So if you think about future inflation and taxes, you would save quite a significant amount of money by paying early versus waiting to pay throughout your 30 years of retirement.
Right. It's all about having the right plan.
Mm-hmm.
Here's one called the Rule 7702 plan, cash value life insurance. Without getting too wordy, you know, it's designed to generate tax-free income, and it was used by super wealthy people. There's J.C. Penney up on top, Walt Disney, of course. It's one of the most powerful wealth accumulation options on the market today. It's best for people under 60 years of age, and it's used also for legacy planning. You get the market-like gains without market risk, as we talked about earlier, and you're also able to protect loved ones with, from the financial burdens with a large death benefit. That's a perfect way to plan for college and retirement with a single investment. And life insurance has changed dramatically over the last 25 years. You can build a non-taxable retirement with this Rule 7702 plan.
So I want to add a couple things here. I actually have a personal story that I like to tell about the 7702 plan. Myself and my husband purchased one of these for our goddaughter. So even if you are over the age of 60 and you decide to use this for legacy planning, you can still utilize all of the tax benefits and indexing power of the investment for the people that you want to ensure are taken care of when you're no longer around to take care of them or provide for them. So we bought this policy for my goddaughter when she was born. We will fund it for the first 15 years of her life, and then we'll never have to fund it again. And because she has such a long time horizon and those dollars earn compound interest, she will be able to withdraw tax-free, or she'll be able to take a loan against the cash value tax-free for 4 years of college, for her first car. If she's buying a house and getting married in her 20s and 30s, she can take a loan against her policy for those things as well. And then she would leave the policy alone and let it grow as she, entered her career and earned her own money and had her own retirement account. But because of the long time horizon she had and a little bit of planning ahead of time, she will retire a millionaire just from this one policy that we've provided for her and investing in it diligently for the first 15 years of her life. So that just gives you an idea of the power of cash value life insurance and how incredible it can really be.
It's a great story, Brandy.
Thank you.
So you can build your own story when you contact us about that as well. And, let's talk about expenses for a minute. Reviewing and reducing your total monthly spending is really important. A lot of people don't do this. You begin to spend less immediately when you do this exercise. You pay yourself first by saving, and then and only then should you spend money. You add your last 2 months of spending and divide by 2 to get an idea of how much you're really spending. Okay, so that's basically how you do it. You do not pay your house off with IRA money, by the way. The tax cost is just too great. And also try to downsize and reduce your mortgage or eliminate it. You can take up to a $500,000 deduction as a married couple in your lifetime. And it's a one-time exemption on the proceeds of the sale of your home. If you're single, it's $250,000. By the way, there's just a few details on myself, North Star Financial. Guarding your wealth in North Star way. It's kind of a motto that I have, and we deal with all types of people. Like I say, I've been doing this now for 21 years. I encourage folks to listen to my radio show on 99.5 WRNN, which you can see the call letters on the left there. And up top, you'll see my phone number, 843-448-7305. Email starnorth007@icloud.com. And make sure you drop by our website, northstarnavigator.com. We also have a lot of information up there for you to avail yourselves of. Over on the right, we talk about annuities in this webinar. But when you look at your annuity, I'm really specialized in giving you the best advice on your annuity. So if you want to set up an appointment and find out why your annuity may be not working as hard to give you the best income outcome. There are annuities, and then there are the good annuities that are out there. It's all about having the right advisor. Also, variable annuities, they can be problematic with hidden fees. Why not find out about how to get around all of those fees and have all of your money working for you all the time? So there's some details there. And we just invite you to set an appointment with us today. Visit our website at northstarnavigator.com. And again, there's that phone number, 843-448-7305. There is a contact button over on the right-hand side. So if you click on that on my website and you can contact us, anybody, we'll be back to you within 24 to 48 hours to set up a perfect time to do either one of these meetings here, like a Zoom meeting, or where you can come right into our offices. The theme is to make sure you, your family, and your retirement is protected. And that's what we've been doing since 1999.
Thank you so much for sharing all of those very important topics with us, Patrick. To all of our viewers today, we really hope that we were able to provide you with some value, maybe a little bit of education, and perhaps you learned some new things, or you have something that you want to talk to us about. And I would, again, just like Patrick said, I would encourage you just to reach out and talk to Patrick about how he can help you. You know, you have nothing to lose, and the worst case scenario is that you leave the conversation a little bit more knowledgeable. So thank you again, everybody, for joining us today, and we'll see you again soon.
Thank you, Brandy.